Would you take retirement advice from a billionaire? Hopefully you answered yes, but you don't have to have Warren Buffett, Jeff Bezos, or Bill Gates' phone number in your phone in order to take in their investment wisdom and apply it to your retirement plan. In today's video, I'm going to share with you 6 tips that you could take away from the 2018 Berkshire Hathaway shareholder letter and how you can apply those to your retirement. Are you ready to get started? Let's go. So the first big takeaway is that Warren believes that companies are very expensive right now. Berkshire Hathaway is a holding company built up of smaller companies. Simply put, they make money by acquiring companies and making them more profitable. And this is very similar to a mutual fund or an exchange-traded fund that you may invest in your IRA or your 401k. What Warren points out is that the cheap debt has fueled management to make decisions that they probably wouldn't make if the cost of borrowing money was more expensive. Now, why is this happening? It's largely a result of the central banks around the world who have been suppressing interest rates and then also providing financial stimulus in the form of quantitative easing or bond purchasing programs. And so these type of programs have distorted the real risk in the financial assets, and as a result of that, the price of assets, the price of companies has gotten very expensive. And Warren points this out, and in the end of this video I'm going to show you what he's done as a result of these prices getting so expensive. The second lesson from the 2018 Berkshire Hathaway letter is that Warren uses insurance company as a financial engine to drive Berkshire Hathaway. So Berkshire Hathaway owns Geico and General Re, a big percentage of General Re insurance company. These insurance companies make their money by collecting premiums for auto policies or business policies, homeowner policies, things like that, and then investing that money into productive assets. Now, they'll have to pay out a percentage of those premiums for claims, and they keep a small percentage of that money. What's interesting is that these consistent premiums are what is used for Berkshire Hathaway to go out and fund investments. So in your retirement, it's constructive to look at what consistent, dependable income that you have to fund your lifestyle. Typically, you want to have a certain percentage of income that's going to cover your essential needs like housing, food, and healthcare. And a good way to look at your income is to determine how much of your income is guaranteed from sources like Social Security, pensions, or annuities relative to the fixed expenses that you have, your essential non-discretionary expenses. If you have good, consistent income coming in to cover those expenses, then you can take investments that are a little bit more risky and withstand the volatility that may come from the market's ups and downs or an economic contraction. So this is a great lesson, and it's one that's critical that you apply to your retirement. The third lesson is that the gains in 2017 from the tax bill were almost as much as the amount of money that Berkshire Hathaway made from their investing profits. And what's significant for retirees is that this is a tactic that you could apply to extend the longevity of your money. It's not a really difficult concept where if you keep more money by paying less taxes, then you can extend how long your savings and investments last. And so what's really great about this is that Warren points out that this tax bill has allowed them to become more profitable, and it's almost doubled their profitability. And so as you go to plan your retirement, you should really look at your effective tax rate and your marginal tax rate as you enter into retirement. But you should also extend what those rates will be over the first 5 to 10 years of your retirement. By looking at these rates up front before you retire, you have an opportunity to potentially shift some assets from tax-deferred vehicles like an IRA or a 401k into non-qualified vehicles like a brokerage account. Now, why would you want to do this? Well, if you can pay taxes at a lower rate, then when you have to start taking distributions out of your IRA or your 401k, you may be able to lower your tax bill. Essentially what you'd be doing is pulling the taxes forward and preferably in years where you have a lower tax rate. So maybe you retire and you won't have any income coming in. So at that point, you could consider taking distributions from your IRA or your 401k to a certain level. Now, if you want more information about this, just comment below or reach out to me personally, and I'll share with you a study done by the CFA Institute that applied this strategy, and they were able to extend the longevity of assets by 7 years. This is a great strategy that anyone can use regardless of your net worth. Now, the fourth lesson that you can take away from the Berkshire Hathaway 2017 shareholder letter is that Warren Buffett is starting to raise cash. In fact, last year he increased his cash holdings by 35%. Now, how is he doing this? Well, he is taking a percentage of his investable capital and he is moving it into short-dated bonds. He's doing this because he looks at the interest rate market and he thinks that the U.S. Federal Reserve will increase the interest rates. Over the past few weeks, they've said that they want to increase interest rates by up to 4 times this year. As interest rates rise, bonds could lose value. As a result of that, Warren doesn't want to hold long-dated maturities. These are bonds that mature in 10 or 30 years. The reason that he doesn't want to do this is because if interest rates are going to increase, those bonds are going to become less valuable. And so what he's done is he started to shift his investable capital into short-dated maturities, and he gives you the number. He said the average maturity is about 88 days, or average duration is about 88 days. So as a retiree, it may be constructive to look at your bond portfolio, your bond holdings, and say, what is the duration of those bond holdings, and what is the interest rate risk if we're going to have interest rates increase by up to 4 times this year. Now, the fifth lesson from this shareholder letter was that index funds actually beat out hedge funds. You may remember that Warren Buffett made a famous bet with protege partners in betting that index funds, the S&P 500, would outperform any hedge funds over a period of 10 years. And they bet, Warren and protege partners bet $1 million to a charity of choice for the winner. The results are pretty interesting, particularly for investors, because what you see is that no hedge fund consistently beat out the S&P 500. Now, we've been in a pretty unique environment with the quantitative easing and the financial stimulus that have been offered by the U.S. Federal Reserve and other central banks around the world. That tailwind has allowed index funds to really outperform active managers, which you typically see in hedge funds. But regardless of that, what you've seen is that over the past 10 years, these index funds have outperformed hedge funds. And so as a retiree, it's constructive to look at the investments that you're holding and the fees that you're paying. Specifically, you want to look at any mutual funds that you may be paying, particularly in your 401k plan. Oftentimes I see retirees are still holding A shares in the 401k. Now, these are high load investments that typically can be replaced with an alternative that can dramatically reduce the cost of the investment. So if you're going into retirement, or if you're currently retired, take a look at your investments, particularly for A shares or C shares, and see if you can reduce the fees of these investments and still keep the high quality investment allocation. Now, the final lesson offered from this shareholder letter was that high grade bonds pose significant investment risk. As I mentioned before, the potential for rising interest rates will affect the value of bonds. As a result of that, Warren has shifted his duration down significantly and reduced his bond exposure so that he is not impacted by these rising rates. So a lot of people believe that as you go into retirement, you need to have a 60-40 portfolio where 60% of your money is invested in stocks and 40% is in bonds. This is not the case anymore in this investment market because bonds are no longer risk-free. In fact, as interest rates rise, they will pose significant risk. And if you are going to be depending on those bonds and that income to provide for your lifestyle in retirement, this could be a big threat to you. So take a look at your bond holdings, take a look at the duration risk that you have, and also the credit risk that is offered by some of your corporate bonds. Doing so could pay off significantly as you transition into retirement. So I want to thank you for watching this video, and I hope that you learned something valuable from it. If you have any questions, make sure that you reach out below in the comments, or if you'd like to schedule a time to speak with me or any other certified financial planner on my team, we'd be happy to give you some guidance for your retirement. Thanks a lot.